Your market news now. Asian markets resumed their downtrend on Thursday as investors contemplated more interest rate hikes, particularly by the Federal Reserve. While Washington added to China-US frictions and Brexit negotiators struggled to find common ground, the broad rally across world markets in the middle of the week was fueled by upbeat earnings, gave way to ongoing uncertainty. That's about the global outlook. Minutes from the Fed's latest policy meeting showed board members expect to hike borrowing costs as the world's top economy goes from strength to strength and inflation begins to pick up. Slumping after the Fed set the tone, Tokyo's Nikkei dipped 0.8% to 22,658 while the Hong Kong Hang Seng was actually unmoved at 25,454. Shanghai's composite down nearly 3% to 2,486. Over to the United States now, where Wall Street's major indices slipped on Wednesday after the Federal Reserve released meeting minutes showing broad agreement on the need to raise borrowing costs further, cementing investor concerns that had helped cause a major sell-off the week before. The Dow Jones Industrial fell 1/3% to 25,705, while the S&P 500 was marginally down at 2,809. And the minor downfall for the Nasdaq Composite as it closed at 7,642 points. It's been negativity for the local market for quite some time now, and that continues to be the case. A lot of the stocks taking their sentiments out from Asia, which clearly showed a mixed picture. As you could tell, they're pretty much flat for one index and the others headed a whole lot lower. Europe also trading in a similar vein, but let's unpack that in detail for you now. As you can tell, there's just a little bit of movement across the board, but the JSE is still sitting in red territory, and we unpack that now with Owen Nkomo from Nkunzi Wealth. Owen, thank you so much for your time this afternoon. We've kept on seeing this negative sentiment across the board. One would have thought that we'd get some sort of bottoming out at some point, but it doesn't seem to be finding that bottom anytime soon.
No, I don't think we'll see the bottom anytime soon, especially if America continues to increase interest rates. The economy is doing so well relative to the rest of the world, where, we're struggling to find decent pockets of growth. The leader of global growth in the past 10, 15 odd years, China, is starting to also ease a bit in terms of its growth. The markets in China under a lot of pressure as well. As you've seen from the peak, the Chinese market, the composite index is down about 30% on the peak, which is quite a significant decline. So it's hard to find those kind of pockets that can match America in terms of growth, which sort of says to me, perhaps maybe America should just put a break on this increase in interest rates, because it's putting turmoil to the rest of the world markets.
That almost sounds like Donald Trump saying that the Fed is crazy. Would you agree with those sentiments, considering what's happening across the world?
I wouldn't use his choice of words, Arabile. I would most probably say, let's go back to the days of, Alan Greenspan, where the tonality of the way he spoke was more measured. He would say, let's use a measured pace. If we want to increase interest rates, let's do it at a measured pace, because it doesn't help America to have a world that's collapsing around her. If the economy is so strong, they still need the outside, the outside forces to help them buy whatever they're producing in the USA. So I really think maybe they need to, like I've said earlier, maybe to just tone down a bit on the increase of interest rates, because it's really not doing much positive, favors for America herself and for the rest of the world. I think they can afford to hold on.
It does seem like America against the rest of the world, though, right? It's that protectionism that has really affected the markets now, and it's clearly visible with everyone just headed in their own particular direction. It's pretty much a case of fend for yourself, including the emerging markets.
Yes, most definitely. I mean, to see the impact of these American policies, you just have to look at China's companies. They're really struggling, as a result of these tariffs that are being charged by Donald Trump's government against the rest of his trading partners. And I do think that, if Donald Trump continues his his current pattern of leadership, we really won't see the bottom of global markets anytime soon. We will see retaliation coming from China. We will see retaliation coming from some of the European trading partners as well to America. And I think the level of uncertainty, Arabile, is the reason that the markets continue to collapse. There is not much, there's not that much of a big risk compared to 2008 and 2002, where we had major systemic risk. But Donald Trump at the moment is, in my view, the biggest risk in the economies of the world. If you look at the price of oil as well, his relations with Saudi Arabia and, his continued antagonism to the people that produce oil is not working. People have stopped thinking about things from a global perspective, and they're looking at it and saying, what is Donald Trump saying to us, and how do we respond to that?
But that's lower than $80 a barrel now, which surely should signal some good signs for non-oil exporting nations like ourselves.
No, look, I mean, it's still a long way to go. $80 is still a lot of money. You almost needed to be back at $60 a barrel. But
what are the chances of that?
No, look, it's possible. It's been there. We've seen oil price go down to $30 2 odd years ago. And I think with the right conversations happening in terms of global leadership and OPEC, you potentially could see some more amenable agreements to see output being increased by the oil producers. But at this stage, it's really, in my view, the person that's leading the conversation, trying to get oil prices to come down, which is Donald Trump, who is a big consumer of our imported oil, is just not the right man to be doing these negotiations because of the way he behaves when he's sitting at the negotiation table.
A sad picture on that front, because at the same time, the two things that we probably would look at again would be the oil price and the currency. The currency seemingly, coming through a little bit and actually helping somewhat.
Yeah, the currency at 14.20 definitely.
Yeah, right. So one would have hoped, though, that it goes a little bit lower than that mark of 14 Rand. But can it sustain the sort of strength for some time at least?
Look, once again, it's a matter of what's happening outside the country, the global dynamics, geopolitical dynamics that are happening. The price of oil is important. All these continued trade wars are very important. And whether or not we continue to see developed markets investors exiting emerging markets, and selling emerging markets currencies, whether the troubles we're seeing in Turkey, Argentina, are going to persist from an emerging markets perspective. I really do think that those things are very important for us to see the currency firming up. If only those things could change in a positive direction. Brazilian interest rates sitting at 60%, Arabile, it's ridiculous. So the emerging markets are really under a lot of weather at this stage. And let's always remember as well that we must look at the South African story from a global perspective, not just a South African perspective. We've got our own issues here at home, but I think, if we took away the global issues, the rand will be trading much stronger than it is, because I think our issues outside of growing the economy, I think we can manage to at least tame the drama that's happening in South Africa from a sentiment perspective.
Yeah. Let's talk about the mining data having just come out as well. We had retail sales come out yesterday, which seem to be out of touch with what's really happening on the ground in South Africa, rising around 2.5%. But mining dropping 9.1%, however, that's a big blow. Yeah, it's a big blow, definitely. And these numbers are not, they concern us when it comes to the GDP reading for the next quarter. I believe that the retail sales numbers we had yesterday, coming in 2.5%, ahead of a 1.6% expectation from the market, they were very good numbers. Some people are starting to talk about maybe we're going to get out of the technical recession. I think it's too early to call it, Arabile. There's still a lot more indicators that we need to see. August data as well.
So there's still a lot more indicators that we need to glean through. We still need to go through September as well. And I think potentially, given what's been happening in the global markets, especially in the commodities markets, outside of coal and a few other sectors, the rest of the mining subsectors haven't done that well in South Africa. So it's a big concern. And mining, is obviously a contributor as well. Not as much as it used to contribute in the past, but it's a contributor to the GDP count as well.
Oh, and I'm going to ask you very quickly, NTBPS next Wednesday, investment summit as well on the Thursday and the Friday and the Saturday, actually. What would you give as advice to Tito? So tips for Tito, number one, very quickly, and your investment sentiments.
Look, I'm hoping that Tito will come in with a fresh pair of eyes and hands and say, I'm going to be tight on controlling government expenditure. And at the same time, I'm going to look for those easy wins where I'm going to push for more people to get employed, especially putting money to to work in the small enterprises space, Arabile. I believe that that's the only way we can increase unemployment. And from an investment, conference perspective that's going to be led by the president there, I do hope that it continues to attract, more cash to take him to that $100 billion target. We need to push the economy higher.
Owen Nkomo there from Nkunzi Wealth, unpacking all of that market picture. That's where the buck stops with regards to that, but we'll give you more business news right after this. Do stay tuned.